Good morning to everyone joining us. Very briefly before we start, we have got 4 of us on the sofa today, and therefore you'll probably find it easiest if you'll switch to gallery view so you're able to see us all at the same time. If not, you might find switching between us on speaker, you get sort of glimpses of us and then on to the next person. So welcome to the second in our Patient Capital on the Sofa series. Today we're going to be discussing patient capital in the context of the stewardship model, but more of that to follow. Brief details about those following on in the series. The third is next Thursday at 10 o'clock, where I'll be joined by Charles Staveley, who's the Head of Real Estate Investment here at Mills and Reeve, along with Anna Rule, who's Head of Real Estate Assets at Railpen, and we'll be diving into a discussion about institutional investors' approach to patient capital. And then we'll conclude the series on the 18th of March, again at 10 o'clock, where my colleague Tom Nash and I will be joined by Ian Keys of Bidwells, where we'll be hopefully engaging in an interesting discussion on colleges, agricultural estates and overseas investors in the context once again of patient capital. A little bit of housekeeping before we start then. For those of you who maybe have only just been allowed in, I did say you're probably best on speaker probably best on gallery rather than speaker, as you've got 4 of us on your sofa today. This is being recorded. Therefore, if you don't get enough of us today, there'll be an opportunity to listen to us once again. They'll be emailed round with a link to the recording after the event. There is in your bottom ribbon a little Q&A function. So if you have any questions that you'd like to ask or they come to you during the course of the webinar, please pop them in there. I'll do my best to weave them in as best as I can. And if not, hopefully we'll have a few minutes at the end to answer those. If we do run out of time, which sometimes we do, I will still take your questions away and ask our guests if they might give me some written responses. So if you're happy to attribute your name to that question, only I'll be able to see who's raised that question, not other delegates. I can then ensure I follow up with you personally after the event. And last but not least, we really value feedback. So please, if you just have a few minutes at the end, when you log out, you'll be asked to fill in a feedback form. I'm really interested to hear what you enjoyed about today, things you might like to hear more about in terms of webinars for Mills and Reeve, and also any specific points you'd like us to cover in the upcoming 2 webinars as part of this series. So without further ado, I will just introduce you to the speakers today. So I'm joined by my fellow partner, Lauren Parker. Lauren is a private tax specialist. And then we've got 2 great guests. Firstly, in the form of Gail Mayhew. Gail is a principal at Smart Growth Associates. She was also the commissioner on the Building Better, Building Beautiful Commission, appointed in January 2019, member of New Anglian Let Building Growth Group, and also worked on the Corporate Strategy England Partnership. So it's got a great track record of advising clients across both public, voluntary and private sectors on placemaking. Our second guest today is Charlie Dugdale, who's a proprietary partner at Knight Frank. He specialises in development partnerships across the UK, a particular expertise in advising landowners, and by that I mean both private families, consortiums or local authorities. He led the Knight Frank team that was appointed by the Building Better, Building Beautiful Commission to undertake research and provide an evidence base for the Commission's policy proposals. It informed those. And his ambition is to build beautiful homes with expertise straddling both public and private sector land, social and private housing. So I think we can all agree individually a great set of credentials to be talking to us today. However, where there's power in a collaboration is that both Gail and Charlie are the co-founders of the Stewardship Initiative, which is why they are here today. And for those of you who don't know much about that, this will be a great opportunity to learn more. If I were thinking about how we might summarise what that is from my own understanding, it's an approach framed in unlocking housing delivery and placemaking through embracing a longer term time frame for delivery and building partnerships of interests. And a great summary, a great quote that Gail, I've heard her say before, it's a coalition of the willing. So without further ado, I think we might just get into the content of this webinar. Now, one of the recommendations of the Building Better, Building Beautiful report was about embracing this stewardship model. So Gail, I wonder if I might come to you first. For those of our listeners today who have limited knowledge of what that is, maybe you can talk to us about what we mean by the stewardship model and also why patient capital is relevant to its success.
Thank you, Carina. Thank you so much for the chance to speak to such a great group this morning with so many interests involved. What we were looking at in the Building Beautiful Commission was obviously to try to define how what better quality development in the first place is, but also how we might get there. And so in the process of looking at the how we might get there, the kind of how to rather than what it is, we looked quite hard at the best examples we could find of the highest quality residential urbanism, both contemporary and on a historic basis, to look at what the commonalities were between how those projects had been produced, and to interrogate whether there were lessons that we might learn from that in terms of rethinking how the development model might be shifted to be able to produce that level of quality on one hand, but were there clues to the unlocking actually of some of the stalled bigger scale projects that that we're all kind of exercised in trying to find a solution to. So in interrogating those schemes, what we got to was the commonality sitting behind all of them was a longer term perspective, which I think we might term patient capital. But also another dimension, which was where the concept, the narrative of stewardship began to sort of come into it, which was to look to a wider set of impacts than just the narrow focus on housing, how that development sits within its wider context, how it works for the broader variety of people who might live, work, and actually this was the other dimension to it, that this isn't just about building housing, it's about building communities. And that to us is really the central core of the stewardship proposition. This is how to build a new part of town that actually has longevity and real buy-in from everyone concerned.
Thank you. I think we can all appreciate and relate to the importance of community, especially over the last year when actually our immediate surroundings have become so much more important to us. And you mentioned there the long-term, what we might term as patient capital. And Charlie, I might address this next one to you, because of course we are in the context of this series discussing what patient capital is and how it might assist with certain forms of delivery and development. I wonder if you might give us some pointers on what effect that form of investment in the stewardship model has, both on profitability and also on popularity as to that as a model, and why.
Sure, and thanks also from me for having me on today. I should also mention there's a third wheel to the stewardship initiative, which is Ben Bolger of the Printers Foundation, who's been integral to all of this. Yeah, so the question on profitability, popularity, I think this is really the question that the Building Better, Building Beautiful Commission asked of Knight Frank. Gail didn't like us to talk too much about profitability. She prefers to talk about value, but I'm going to answer the question in respect to profitability. So in our research, we published a report called Cost and Value last March, and that concluded that on average, value was increased through adopting a higher quality approach by approximately 15%, and we showed that, particularly over the longer term, that more than covered the additional costs of adopting a higher quality approach. And so time horizon, once again, is a very important function of stewardship. But actually, as a follow-up to the report, I mean, the one thing that we see is really moving the dial in terms of profitability and the impact of stewardship is basically reducing the risk for the house builder. If through landowner-led development you can provide a landscape which mitigates their risks, and by that I mean branding that allows homes to basically sell themselves, a really strong planning strategy, and perhaps most importantly, patient capital, being prepared to wait for their return, and that. This sort of optimum point there is the moment that houses are sold, because that's the last possible moment that the landowner can have a control, and it's also the point where the end occupier needs the freehold. So by deferring to that and by mitigating risk, house builders are prepared to reduce their margin, sometimes to the tune of 5 to 10%. And if you think 5 to 10% off the GDV of any project, that's a really big number. and can actually cause the total return to approximately double. I liken it to the marshmallow testing. Are kids prepared to wait 15 minutes for their second marshmallow? And I think the same question is asked of landowners within stewardship. So doubling money sounds like a big windfall for a landowner, but I think it's really important that we reflect that additional value in stewardship is actually reinvested into the land. A landowner is inherently linked to that locality. So, for example, Knight Frank and Mills and Reeve are working with the University of Surrey at Guildford, and you can imagine that the University of Surrey at Blackwell Park project allocated for 1,800 homes. All of that profit is going to be reinvested into Guildford. They account for, I think, 40% of the local economy of Guildford, which I think is a staggering statistic. But all that investment goes back into education, into key workers, into research, into incubator units for employment. So I think there's a really strong story that stewardship doesn't, money doesn't leak out of the community. So I think there's communities can be really confident in the stewardship model. That also, I refer to key workers, and time again, we see that landowner-led development delivers, in many cases, exceeds on affordable housing ambitions, which I think is really important. We find that it's probably fair to say the regional bespoke house builders or SMEs are a bit more adaptable in their margin to some of the majors, and also adaptable to, or should I say, receptive of some of the controls imposed by stewardship. And so we would argue that stewardship offers a landscape for that sector of house building to grow, which I think is really important for the future capacity in this country. And I think it's also fair to say that they're probably more adaptable to non-residential uses. And I suspect we'll come back to mixed use development later on in this webinar.
Thank you.
Thanks, Charlie. I think it's clear that there's some potential significant benefits to the stewardship model for all the stakeholders, but also the wider community. And just turning back to you, Gail, I wonder if you could explain what the key factors are that could enable a move towards that stewardship delivery model.
Thanks, Lauren. The community obviously sits at the heart of this, because we see the initiative as sort of triangulating the public interest around delivering on housing, the development industry interest in actually getting development started at much higher volumes in terms of the large sites. But the critical thing is actually that we bring communities along with us. And I think going back to Charlie's point about mitigating risk, actually this is one of the aspects of stewardship that we think is a real game changer, because if you have a trusted party taking forward development in the manner that has been consulted upon, with all the kind of infrastructure built into it that the community wants, the affordability and the placemaking, and our view is that actually begins to mitigate planning risk, and which we all know is one of the biggest and most tricky things to deal with, and potentially speed that process towards planning. So what the characteristics of the model that we've been proposing is, one, that the land should generally be committed as equity on larger scale projects, that's married up with capital of a much more patient time horizon. And those are the two patient capital elements, the land coming in and the capital with a much longer term time horizon, in order to meet the time frame of the exercise of placemaking and infrastructuring, which to us was really, in analysing the problematic of delivering at a high level of quality, the shorter time frame that attaches to house building, it seems to consistently be one of the greatest problematics around delivering on the quality of neighbourhoods. So if we can unpack those two activities and invest in the land and the infrastructure, the placemaking over a much more extended time frame, that's really the golden sort of nugget at the heart of it. Then things which are currently on our horizon is levelling it is resolving sort of tax issues between the partners. So one of the things we want to do is create a playing field which is equal to that of any other development scenario, and so extended conversation we've had between us about how that might be achieved, so that nobody's subject to dry taxation ahead of returns coming into them, we're very, very clear that tax is such a key driver in property. We've got to address what for some people can be quite a thorny and sort of an issue that they want to cast aside. They just don't want to get their heads around it, but we keep bringing it back to the table, and it's a difficult conversation because that gets us into HMT territory, and that's not an easy advocacy position to take, but we're trying to take it on. And then, I mean, from my perspective, there's another dimension, which is supporting a stronger strategic kind of planning position. I think it is really essential that we start moving to a sort of mindset of trying to assess where the right development in the right place is. And it actually something that we should, as participants in the industry, really take on board. If we produce something that's highly responsive to location, we're very much more likely to get a positive planning response in it. But there is another dimension to that, which is, we're talking about large scale allocations, quite heavy duty infrastructure. There is a geographical logic to some of that at the moment isn't necessarily being sort of fully interrogated in the current planning framework, and a bit of a disappointment that wasn't actually an area of focus in the planning reforms proposals in the autumn, but we'll certainly still keep arguing for it.
Thank you, Gail. There were sort of three things. When I read the Building Beautiful Commission's report, there were three policy proposals I was really interested in. One related to the stewardship kite mark, a second to patient capital fund for infrastructure, and the third for, as you mentioned both of those previously, Gail, and the third related to levelling the tax playing field. And if I might, I'm going to address each of those to each of you. So Lauren, if I start with you, one of those proposals was around levelling the tax playing field. What is it about the current tax playing field that is not level? I know it's highly complex, but maybe a headline point for us listening.
Sure. So at the moment, Carina, if a landowner sells land that they're using in their farming business to a developer under the traditional sort of option and sale procedure, then the starting point is the gain that landowner crystallises on making that disposal to the developer is going to be subject to capital gains tax, and the release that they might be able to claim, such as business asset disposal relief, formerly known as entrepreneurs relief, and rollover relief as well, which can reduce their chargeable gain. Now, if by contrast the landowner decides they want to retain ownership of the land and for it to be developed through something akin to a stewardship model, then the actual development of that land whilst it's in their ownership is going to change the tax position quite considerably. So to give you a couple of examples as the sort of structure that might be adopted at the moment, one is that the landowner who wants to minimise their risk might grant a developer a building licence or a lease. Now that's difficult from a tax perspective because it brings into play what are referred to as the transaction in land rules, that mean that ultimately when the land is then disposed of, or the development's disposed of, at least part of that gain is going to be subject to income tax. It rather depends on what Mr. Sunak has to say at the budget later on today as to whether capital gains tax rates are going to be more closely aligned with income tax rates, but certainly at the moment there is more of a differential there. And also when you move from your capital gains tax treatment to your income tax treatment, you start to lose some of those other reliefs that I mentioned. Another opportunity for landowners at the moment is to enter into a joint venture agreement with a developer. And in those circumstances, their land is usually appropriated to trading stock. Now that appropriation to trading stock is a deemed disposal of capital gains tax. And as Gail alluded to, that is one of the points where you get a dry tax charge because you're triggering a charge before you've got proceeds of a sale with which you can then actually pay that tax. Now there is a method for actually deferring that deemed disposal dry tax charge until an ultimate sale of houses. But if you do that, at the end of the day, you end up with the entire gain being subject to income tax, which again is unattractive. Sometimes people look at corporates. So do you actually put your land into a corporate vehicle, which then goes into that JV agreement? The difficulty with that is that you'll have an upfront stamp duty, land tax and capital gains tax charge. Again, dry tax charges because you haven't got sale proceeds from which to pay the tax due to the timing issues. So there are some obvious difficulties there, and they get worse when you've got landowners who are wanting to collaborate with neighbouring landowners to bring forward some larger sites. So very often, to eliminate self-interest in those circumstances, your consortium of landowners will enter into a collaboration agreement, and they'll usually agree that they're going to share the costs and the proceeds associated with the development of the land between themselves in some agreed percentages, and normally they're directly proportionate to either the acreages or the value of land that each landowner has contributed to that pool. Now, that will involve, under the terms of the collaboration agreement, some equalisation payments between the landowners, and those equalisation payments are subject to double taxation, double capital gains tax. There are some ways in which you can overcome that double taxation, but it involves some very complex structuring to deal with the various different tax issues, and that obviously comes at a professional cost, which can be a barrier to landowners wanting to go down that route. Aside from capital gains tax, there is also some inheritance tax issues to consider, particularly for older landowners. So when you stop using your land for farming or letting it for farming, there is a loss of inheritance tax release. Now, that's true where you have a straightforward sale to a developer, because your cash proceeds are not going to be relievable for inheritance tax, but you have in those circumstances got the flexibility to reinvest in relievable assets. So inheritance tax is also a consideration for landowners, which can sometimes push them towards the more traditional option sale route. So I think really, whichever way you look at it at the moment, the tax system is geared up towards pushing landowners in that direction rather than the longer term stewardship model.
Thank you, Lauren. I know Lauren and I have spent many an hours debating the right structure for various of our mutual clients and how to structure it for them. So I can definitely echo it's not without thorns along the way in the current regime. And of course, there isn't one size that fits all. It depends on each of the individual circumstances, certainly in a collaboration more so, of their individual tax circumstances as to which route may be right for the collective. So hence why the level playing field is not currently level when we look at it. The other point I was really interested in, Gail, I think you might be best placed to comment on this. The other proposal was around the stewardship kite mark. And when I read the Commission's report, I saw this as sort of the pulling of things together. It was what you were aiming to achieve. And I was just interested to understand how it was proposing to draw together all those other policy recommendations that came out of the report.
Carina, yes, we definitely, we see it very much as being the kind of filter for a sort of objective standard to attach to a project that meets the sort of stewardship objectives. So, I mean, our intention is to, it's in draft format at the moment. It's got a long way to go. It's actually up on our website, and we can share it with people on the call after the meeting. And we're very open to in a discussion as to actually how that is taken forward. But how we see it operating as a gateway to a set of benefits, essentially. So it's a sort of part of a carrot and stick proposition around stewardship. If people conform to the standards set out in the kite mark, which we've sort of developed both. I mean, they both bring together the essential characteristics of stewardship, but also begin to bring in some of the wider ESG requirements that we're all beginning to have to work to. But our kind of intention is to translate those from being quite sort of high level concepts to things that actually are meaningful and measurable within the context of a residentially led development. So the hope would be that a scheme that conforms to that will actually bring together a lot of the ambitions, one of the Building Beautiful Commission, but broader social and environmental objectives that are really kind of impacting on how we're beginning to have to rethink residential development, particularly in the light of COVID. I think we've all gone through such a learning curve about what we need from our homes, what we need from our neighbourhoods. And I mean, our intention with the kite mark is that it pulls that together into a sort of filter. The intention would then be, and so we see this as some form of self-regulatory device, so that a kite mark would be awarded to an entity that's prepared to adopt those characteristics. That would then open up the tax position that we've begun to explore with yourselves, and which we're hoping to persuade Treasury to look at seriously. It would open up access to patient capital funding regimes and potentially a streamlined planning position. We've begun to look at LDOs as a possible route to helping stewardship land ownerships that have demonstrated their credentials around delivering on quality and content. An LDO could be a way of awarding a beneficial planning position to those kind of entities. So that's where we're pushing our our ideas around this kite mark very much at the moment. And I think, I mean, the platform, this group involved in the conversation here, I mean, we'd absolutely value input from people involved on the call to help refine that position.
And I would just echo that from Gail. If people at the end of this have any comments that they'd like to share with us, or any further questions from this, then please, when you get your email, which has the lovely recording of this, if you want to listen to it again, do use the link to the events email, and any feedback you'd like to give in respect of the proposals or things that have come to mind after the event, please pop them in there and we'll ensure they get fed round to the respective working group on this at the moment. Charlie, your go now. On the third one that really interested me, and this one I think goes to the heart of patient capital, and it was around patient capital being a fund for infrastructure, one of the policy recommendations, and about providing access to this patient capital fund for schemes that meet, as Gail was referring, the stewardship kite mark. And when I read it, the presumption I took from that is it means about patient capital funding things like infrastructure, stewardship, placemaking, and all of those things. If someone were to say to me, who would I think would fall within that remit, I would say they're very much in the remit of Homes England. Certainly when we come to things like infrastructure funding, I think we'd all agree it's difficult to see a comparable in terms of infrastructure funding to Homes England at the moment. So I suppose the question for me around that is, what does that mean for Homes England's role in this market if the stewardship model is adopted?
Yeah, good question. I mean, I think you're absolutely right. Logic dictates that Homes England are in the right place to be the nexus of a form of stewardship investment fund. You know, they are the nation's housing accelerator. They're frankly at the moment pretty much the only show in town in terms of infrastructure lending, because it's typically seen as too risky, and of course Homes England are there to address market failure. So you know, we are in discussions with Homes England. We're very grateful to have had a very positive response from them, and we hope that continues. It's not to say that others can't do it. It's been really heartening to see some local governments taking the lead, and examples such as Cornwall Council, who established Treveth, who's basically a stewardship investment fund in all but name, investing over a 40-year time horizon for the future of Cornwall. So that's, you know, that's really great to see. Also, we've seen it in the devolved nations. Scotland has established the Scottish National Investment Bank. They just kicked off. I'm just reminding myself they have a mission to provide patient capital to build a stronger, fairer, and more sustainable Scotland. And I see their emphasis has been on building communities, which, you know, I think emphasis on communities rather than just building homes at all costs is perhaps a lesson that we need to reflect on in this country. But you know, whilst local government, devolved nations, Homes England definitely have a role, there's also a potential role for private sector investment in this space as well. You know, logic would dictate that sovereign funds, institutional funds, if this becomes more portfolio based rather than project by project, then risk can be shared, can be more balanced, and actually the returns from these projects would appear more like a bond, and so it's very much in their sort of long-term investment space. So we do see a big opportunity for the private sector. It's also, of course, got a big social impact value, we would argue, but we do believe that government's got a role to play in demonstrating this opportunity and leading on it.
And actually, just to follow up in terms of Homes England and sort of a marrying of acknowledgement and sort of the following that's the stewardship model is happening. I heard Peter Freeman talk on an IPF question about accelerating housing delivery week before last, actually, and he did specifically reference the stewardship model. And obviously, those of, I'm sure everyone here knows, Peter Freeman is the chairman of Homes England. So it was great to see actually that there is a marrying up of people's perceptions and understanding and knowledge of the existence and the trajectory of travel in respect to this model. So good.
So Charlie, just asking you a further question, what type of person would most benefit, do you think, from a regime that's supporting a stewardship model which is underwritten then by the stewardship kite mark? Is this for a range of different landowners, or do you see it as being specific to one or two types of landowner?
To my mind, it's anyone that has the capacity to think long term about delivery of land, and any landowner could fall into that category. Typically it is farms and estates, but it should also be and can be and is local government. In fact, the whole public sector estate, I think, should be thinking about this. I've already mentioned universities, charitable bodies, these sort of entities, and of course the Church of England, great example. They produced their report last week and challenging themselves to think about their land ownership in a stewardship model. So that's really heartening to see. But our view is that, clearly not everyone can think long term, and we think that everyone should have a neutral choice, and that comes back to the tax regime, but it also comes back to people's attitude to risks and arguably also the advice that they're receiving. It's possible that agents often lean on clients to move towards a sale when that might not actually be the best thing for them, and Knight Frank might be guilty of that. So we wanted, within the stewardship initiative, we wanted to test the appetite of this model. How many landowners are out there? So during the first lockdown, Gail, myself, and Ben spent just a few weeks phoning a few people to see how many were out there that who would adopt stewardship if there was this encouragement in place to do so, the sort of measures that we were talking about earlier. And we sought to have or to identify one landowner in every county just to demonstrate that it had a broad geographic reach. And we were bowled over by the response, and we had very quickly identified 165,000 homes that would come forward into stewardship that were either permissioned already, allocated, or potentially being promoted. So there is a big appetite there, and we think that's just the tip of the iceberg. Many talked about the fact that they wouldn't release land for development because they thought it was going to be terrible housing delivery and dormitory and not what they want to see. So I think we should also be seeing this these landowners or this opportunity as potentially complementary, at least in part, to what is being released for development already. So I think hopefully that answers your question.
And if I could also come in, one of the things we're really conscious of is that the motivation towards stewardship, the essential role that the landowner plays is really what we built a lot of the thinking around. But we're also kind of quite sort of critically sort of aware that if we could actually develop that logic so that communities could come together around the concept of stewardship and actually require that of the development process. And how, one of the questions that we posed ourselves is how does that actually work within the planning system, and is there a way to empower communities to make that ask of development as it's coming through local plans and such like. So we are working with in a couple of localities where we've got kind of local political support, very keen to look at how they can impose stewardship on the growth agendas that they're embarking on. And so it's really, I suppose, the point that I just really sort of be keen that we could be that we're sort of pushing towards is a model that's robust enough to be adopted in any development scenario if there's a coalition of interest around this aspiration of stewardship. So if we can find a mechanism that enables a community to require it, that might also become part of what the stewardship landscape that's emerging might be in. I mean, we've got, I mean, the obvious things, governments encouraged community land trusts at some, you know, and we're anticipating there may be, you know, more support for that sort of thing. But is there a mechanism within the planning system where, you know, actually tracking back through the planning process around about the stage at which land is allocated, is there a scope at that stage for a negotiation to take place between the public interest in its broadest sense and those people who are the landowners who have a lot of sway over the outcomes, to be forged in a slightly different way? So we're looking at that quite hard at the moment as well.
Thank you both. I don't think we can go to a webinar at the moment without, unfortunately, mentioning COVID, which none of us thought we would be mentioning 18 months ago. But we're in a world now where we are going to be living with COVID. And I know personally for me that the biggest change I've had is having to benefit from and utilise as much as possible those amenities that are close to me. And that has meant that I have put my trainers on and I have walked far more in terms of use of local amenities than ever before, because so often we've got into the car, we've driven to work, or we've got on the tube, or we've got on a train, whereas working from home, that's not what you do. You try and make the most of your surroundings. And I was really interested to see the research that had been done, of which I know Knight Frank have been part of, around walkability. And therefore a question for both Gail and Charlie, and maybe Gail, I'll come to you first, is how this concept of walkability plays into the stewardship model.
It's totally fundamental to it, Carina. I mean, this is one that is very close to my heart, and I think, you know, our partner in the initiative, Ben Bulger at Princess Foundation, and I've been really kind of working for years on trying to make the case for walkable neighbourhoods as being an absolutely fundamental part of what we should be doing, partly from a social equity point of view, giving people access to all the things they need on a walkable basis, and partly answering some of the issues that we have around sustainability. So, I mean, there aren't many good aspects of lockdown, but I think one thing that it has brought home to us is how very, very important, you know, bringing those kind of amenities into our communities is. So the starting point for the work was years of work that have sat around this concept of walkable, what the constituent parts of a walkable neighbourhood are. How can you build in both walkability into the street network, so it's that hierarchy of streets, but also the disposition of uses that surround our homes. And I mean, unfortunately, because of this sort of greater and greater footprinting of almost everything we do, public services, so the doctor's surgery gets bigger, the schools get bigger, but they also get further away. And some of this logic is actually about looking back at sort of pre-1920 urbanism, where actually you couldn't take the car for granted. People had to walk, they had to take public transport. And actually the great factor in this is that if you look at those neighbourhoods that were delivered under that kind of walkability model, they tend to be the places that are most popular in the second-hand residential property market. It's the inner urban suburbs of the Victorian and Georgian sort of layers of growth of the city. So this isn't about futurology and thinking about, you know, how can we invent a new urban future that isn't tested, that creates a whole load of risks for developers. It's actually looking at what the characteristics are of some of the most popular and valuable bits of urbanism that we all kind of aspire to living in, and unpacking what those characteristics are so that they can provide new build development a model for success. So what we've been doing, Charlie will talk about the modelling that we've done in more detail, but effectively we've been using technology to try to understand the layering of land use and the flows of movement through those traditional suburbs so that we can begin to create a model for new growth.
I've seen those maps, those great maps that have been published as part of the research, lots of colours. I'd recommend everyone to have a look at that research. It's really fascinating, the difference actually if you see a really well planned walkable community in comparison to one which is not the case. Charlie, is there anything you'd add to that?
Yeah, I'm going to avoid going into all the technical aspects of the GIS stuff. I'll leave that to the bright people at Space Syntax, but I think it's pretty well set out in the report that we published in December, or rather the Printers Foundation did. Yeah, I think walkability is just a massive part of stewardship. Stewardship is all about delivering mixed-use, walkable, sustainable, socially resilient places, and I think to some extent walkability highlights some of the flaws in our current model. You sell land to house builder builds houses, sells houses, moves on, and that's what we're trying to do here. We're trying to create a new model which has a long-term view, and the long-term view recognises that places that are sustainable, that are mixed use, that walkable, are the right answer. So it's a real, I think it's a much more powerful motivation to to have this long-term motivation, rather than perhaps what some people would see as the answer, which is a stronger planning regime. I mean, yes, it obviously can be coupled with planning, and that's part of what we were trying to do with our report, to give tools to planners to be able to measure walkability, because of course you can't improve something until you can measure it. So that was really the philosophy that we took to that report. But to my mind, motivation, the carrot is a stronger tool than a stick. So we would see stewardship as the carrot, if you like, and planning would be the stick.
Thank you. Now, I did promise as part of this series I wouldn't keep you all more than 45 minutes, so we are close to time. There are a couple of questions I haven't got to during the course of this, but I can see in the chat, in the Q&A, that people have attributed their names, so I will follow up with you individually. I'll call upon Gail and Charlie to give me some written responses to those, and I'll pop emails to each of you separately. Just to say, we've got 2 further ones coming up. As you know, the next is next Thursday at 10 o'clock, where Charles Staveley will be joining me, along with Anna Rule, and we'll be discussing institutional investment and patient capital. But for today, the last thing to say is to thank Gail, Charlie and Lauren very much for joining me on my virtual sofa. And I hope to see many of you, albeit virtually. You can see me, I can't see you, next week. And otherwise, enjoy the rest of your week. And please, if you have time, I would appreciate feedback when you log out. Many thanks.